Welcome to Friday Live. Every Friday, the partners of HPK Provident get together and talk about what we're seeing going on in the markets, the economy, and tying in our blog posts, which reference mostly financial planning topics. So we have David Harper here today. David, how are you doing this week?
We're doing well. Mike, my Patty tells me that she heard something that was very alarming, that all the beaches in Florida are closed on February 29th, February 30th, and February 31st. That don't go to beaches on any of those 3 days.
Well, it's not April Fool's, so what are we talking about here? I have not received that rumor in Jacksonville.
There is no February 29th this year, and there's never been a February 30th or 31st. So
okay.
Feel free.
I haven't really studied the calendar charts since I think what was the exam that we had to do? Was that the Series 7 that like you had to calculate like the days per month for different equations?
Oh yes.
Yeah, so it hasn't been since then. So I'm a little rusty on how many days are in each month. I focus more on the economic data.
Well, that's different. Yeah, there's government bonds pay every day, and then the corporate bonds pay the business days.
Yeah.
Okay. So, and you had to figure out, which is all done by computer now, but okay. We need that information so that we can understand why a computer ticks.
Mm-hmm. Okay, well, our typical format is we cover what's going on in the markets, and then we get into the economic data, and then go into our blog posts throughout the week. So I'm going to start with the markets as always. I'll pull up my chart here. So what we're looking at, we had a good start to the week on the S&P, and that quickly diminished the last 2 days. Now we are off of the lows, as you can see today. I don't know if you can zoom in a little bit. We did hit the 100-day, which is the lower channel of this ascending triangle. So this trading pattern technically could break out either way. I would say more often than not, it breaks to the upside, but we're kind of flirting with this lower bound, and I'm kind of biased to the downside, just given my view that the labor market's weakening. Inflation's still running hot. We have some real concerns over the tech trade. Especially with the software companies.
And the tariffs.
Yeah, a lot of concerns out there. We did have, it should have been a great reaction from the tech space. We had the biggest semiconductor stock report earnings on Wednesday, and it was another amazing report, and guidance was good. Initially, the stock popped, and then investors gave back all the gains the next day and ended up pretty deep in the red. So we didn't really get that relief there. But with that said, although I am biased to the downside on this chart, if we get kind of that bottoming where the tech sell-off is done and we start to get money flowing back into the Mag 7, we could get back to that type of market that we've seen in recent years where those big companies are really carrying performance of the overall index because they make up such a great weight. So I'm just keeping an eye on that. Good news for diversified investors. Like I've been talking about, small caps continue to do pretty decent, international stocks. And really, this is the chart of the 10-year Treasury bond yield. So as you can see, we're kind of breaking down here. So what this equates to is lower yields mean higher bond prices. So it's actually turning into a decent start of the year for fixed income, which we haven't seen too many of those. Last year was a decent year, more so in the taxable space and the muni space. This year it's the flip side. Munis have been doing better, but we've seen we're still trying to recover from that horrible year in 2022.
2022 was rough with all the rising interest rates that went in so fast. Stocks have a better chance sometimes to deal with that, but not really. But the bonds have a rougher time when they have those long maturities stuck at 2%, 2.5%, which looked good when the interest rates were near zero.
Right.
But they rise quickly from 0.5% up to 4.5%. That's brutal. And that's what happened in 2022.
Yeah. And I mean, the last FOMC meeting I referenced last Friday, Fed members are increasingly changing their commentary to more putting rate hikes back on the table, which I went into being a little skeptical of because I'm more concerned about the labor market at this point than the inflation data. So, like I was stating, maybe it's more concern over the falling dollar than rates. Because I mean, even I'll get into it when we get into the mortgage segment, but they can cut all they want. Although they're talking about the opposite right now, I think we're more likely to see rate cuts than rate hikes this year. But anyways, going into the economic data this week, we got the PPI data, which is the wholesale price inflation today. So contrary to the lower CPI report that we got a few weeks ago, this one came in much hotter than expected. Core was at 0.8 for the month. Last month was 0.6. Consensus was for 0.25%. So now we're at 3.6% on an annualized basis versus consensus of 2. The headline number is at 3.4. Came in much hotter on a monthly reading too. So maybe it's not really surprisingly, it's not really the tariff story in this report. The prices were driven by the service sector. So, I mean, it could just be broad in the next report for CPI. But I mean, in that report, the housing component's a big weight. So that could, if that has a similar trend to last month, it could go in the right direction. But there's a lot of forces working off. As I mentioned before, I'm a little more concerned about the labor market at this point than the inflation data. Unemployment rate was ticking up until the previous month, and January data, like I always talk about, I'm a little skeptical of it. We printed 130,000. Next Friday we will get the February read, which I think is coming in at 60,000 consensus. But I expect the very least to see that January report get revised lower. So we will see on that. And as always, we'll talk about that the following week on Friday Live. But besides that, there wasn't much other economic data. Consumer confidence came in a little hotter than expected. Not hotter, better than expected, I should say. And then besides that, durable goods came in roughly in line. So really, it's next week that's going to determine if this ascending triangle breaks to the upside or downside. Like I said, I think I'm leaning more toward the downside, but we'll let the technicals take the lead on that one and judge where we go from here. But we do have a little elevated cash position in our portfolios just to take advantage of pullbacks. And I'm being pretty patient with new client money coming over, getting that invested on opportunistic dips. So
it's really hard to. So thank you, Mike, that you're the one that looks at the financial data and not the tweets that come in the Twitter field.
That's your department, right? Tech savvy guy.
No, but it's a stark.
Are you an active tweeter over there?
Yeah, it's a stark reminder of how policy, governmental and social, how much impact that has on the market, but not so much on the underlying data. Okay, so I'm thankful that Mike pays attention to the underlying data, the fundamentals of the market. We're still in a fairly decent place, although we're still cautious, but you're going to have wild swings in the market based on the crisis of the day, the crisis du jour. And that's just the nature of where we are at this point. And
although I'm a little short term, maybe on the bearish side, I'm intermediate long term. I'm not saying that this bull market's over.
No.
I'm just talking about being opportunistic on potential corrections, which are quite common in the stock market.
Yeah. the day traders are having a field day, and we don't day trade. We are very long-term minded. We do the financial planning. So there's a reason why every position we have in the portfolio is there. So
yeah, and then when the technicals or fundamental story changes, we get out of them. Like we've had big winners that we bought a few years ago that we actually had to exit in, or chose to exit in the end of last year, just because they were falling, and I'm glad we did looking back because they continue to fall.
good. Way to go, Mike. Thank you. Okay.
All right, so you want to get into the blog post here? I have our Facebook page, which shows all of our blog and social media posts. If you go to our website, it's just the blog post. So if you want a comprehensive view, it's more Facebook or LinkedIn. We're primarily video-wise on YouTube at this point. But yeah, we do our thematic themes. So Market Monday, or at least I attempt it to be Market Monday. Sometimes that's delayed a little bit by the time it gets approved. But I do the week ahead forecast. And then Brian's been doing a tax campaign. So David, you want to talk about this one, discussing IRAs and the tax consequences?
Now, if you have an employer-sponsored plan, anybody can make a traditional IRA contribution. It's just a question whether that's deductible or not. Okay, and we're in the midst of tax season, you have until April 15th of 2026 to make a 2025 IRA contribution. Okay, so when you work with your accountant or when you're doing your taxes and you see like you could use a couple of extra $100 or so forth, then you might want to consider a traditional IRA. But be mindful that there are income limits on what your amount is. Now, anybody can put in $7,000 for 2025, and if you are over 50, you can put in you could put an extra $1,000, so you go up to $8,000, and you can do that up until April 15th of 2026, like we said. Now, the taxation of them is that you got to realize that you want to be able to separate deductible traditional IRAs and non-deductible traditional IRAs. Okay, but that's for another time. The simple taxation of traditional IRAs is that you get a tax break of the money going in. So when you take it out years later, hopefully after 59 and a half, because if you take it out before 59 and a half, you'll be hit with a 10% IRS tax penalty plus the taxes due on it. So any distribution from any traditional IRA is considered straight qualified income. That's you're going to be taxed at what your particular tax rate is. Because if you make $50,000 and that's what your Social Security, your pension, or your 401k is, and then you take an IRA distribution of $10,000, just treat it as though you made $60,000 that year. Okay.
Yeah. So you get the tax deduction up front, it grows tax deferred, and then the government gets their taxes when you take the money out, which they require you to do once you hit age 73.
73. And there's no discussion about that possibly extending to age 75. We will alert you when that takes place. Consider that it's 73 till further notice.
And if you have multiple IRAs, it doesn't really matter where you're taking that RMD from. You can take them all out of one if you want, or you can do it per account.
That's right. And
we have another caveat with the income limit. If you don't have access to an employer-sponsored plan, you can make that the traditional IRA your employer-sponsored plan, so that income limit is waived.
That's right. So you could be making $300,000, and if you do not have an employer-sponsored plan, the IRA, like Mike says, you can deduct that. Okay. But we're not permitted to give legal or tax advice. So please check with your accountant and or your attorney.
Mm-hmm. Yeah, good point on that one. Going to our, let's see, what day are we on? Wednesday post. It was about mortgage rates. So a lot of people were very opportunistic and took advantage of when we had low mortgage rates in the pre-pandemic and pandemic era. So a big portion of mortgages outstanding were actually below 4%. That number is 50% currently. It has been trending lower. So especially in the last year, we've seen more people are just saying, we're off of the peak. Rates are staying high for a while. I need a new home. I'm going to buy it. So that's just showing in this chart, more people are becoming less sensitive to what mortgage rates are. And just, if you need a house, you need a house. If you want a growing family and need more space, then, that they're viewing it as more, I'm going to buy it now. If rates do come down, I have the opportunity to refinance.
Yeah. The big takeaway on this is what Mike says. If you need a house, you should seriously consider getting a house. Okay. Yes, the government bonds are the Treasury yields are going down, meaning the Treasury, the prices of the Treasuries are going up. Okay. That usually bodes well for falling interest rate, but it takes a lot of time. Just because the Fed cuts an interest rate, you're not going to see that in the mortgage rates right away. So
and the Fed cuts the short end of the rate, the Fed funds rate, not necessarily. It's not a direct correlation to the longer end, especially given the outstanding government debt. It could remain higher than the past 10 years in general.
Yeah. So the idea, if you're ready to buy a house, don't wait 3 months thinking that the mortgage rates are going to go down. Okay, that's the big takeaway here.
And if they do come down, it's really a coin flip of whether, it's going to create more buyer demand. So that could cause home prices to actually go up. But on the same side, you're likely to get a lot more inventory on the market in both the secondary market and new construction if that happens. So it's, like I said, it's really anyone's guess, in my opinion, of whether home prices will go up or down at that point.
And also, a lot of it also is impacted by geography.
True.
Here in Florida, prices are tending to still go up. Not a lot, but they're still trending a little bit upward or flat. But around the rest of the country, Texas, because of so much people moving to Texas and Florida, probably is going to keep those housing market high. Up the Northeast or other places up north, people are tired of the cold and snow. Well, it might be you may not get as much if you're trying to sell your house, but it might be a good buying opportunity for those that want to get a house. Okay.
And they're really working in Florida to eliminate property taxes. I don't know if that'll come to fruition or not, but it did pass the House. If that did happen, I would imagine we would get even more inflow population wise in the state.
Okay. I tell you what, there are 5 different pieces of legislation, and the one did pass the House. Like you said, Mike, that scares me. That's where most of the county governments, and there's a lot of counties here in Florida that derive the most of their income from those property taxes. So I'm not sure what has been made in those bills to support county government. We got sheriff departments, we have fire departments. So I'm not so sure if it's going to come on the ballot in 2026. So I'm not sure if that's necessarily a good idea. But
well, they'll get their taxes somehow. I don't know what that means at this point, whether it's higher business tax, higher sales tax. but they need to have revenue coming in, so someone else will pay for it, or we'll still pay for it, just in a different form.
Well, we'll see. But
I'm just happy with the extension of the increase in limit on the SALT, the state and local tax deduction. So I'm very happy to be able to deduct my high interest payments at this point.
Yeah, well, good for you, Mike.
We did a state post on Thursday, which goes into how often you should update your estate strategy. And the simple answer is pretty much anytime you have a life event. If you get married, if you have additional children, if you are planning to sell a business or sold a business, if you just have a new favorite beneficiary.
Or you happen to you get remarried and your spouse brings other children, so you have an instant blended family. You want to make sure that your estate is set up the way that you want it to go. Okay, very good reason. And perhaps one of the biggest thing that you can do is get a will or a trust. But you get a will. There's so few people in the U.S. that actually have a will.
Yeah,
so 31%.
Yeah, the stat in this article is, although 83% of Americans see the importance of having an estate strategy, only 31% actually have a will in place. So if you do not currently have a will, it's a good time to take a look at that and maybe talk to an attorney and get that established. Now, on the investment side, you can put you have to on IRAs. So that's taken care of. On non-retirement accounts, you can add a TOD, a transfer on death form, which also doesn't require a will. But when it comes to your other assets, they're outside of that umbrella. So you want to make sure they're going to where you want them to go and not where the government says that they should go based on your estate structure.
Absolutely. So thank you so much for your time with us. And if you go to the beach, I'm glad it's not February 29th, February 30th, or February 31st. Enjoy your weekend, folks. And Mike, do you have anything to add?
Just that next week we'll have a lot of things to talk about on Friday Live. It's economic Armageddon with the data that we're getting. So we'll have the ISM manufacturing, services, ADP numbers, Challenger job layoff report, non-farm payrolls, and then employment data on Friday, and also retail sales. So pretty much everything you want to see as an economist minus inflation data.
The February report shall be a whole lot more fun for you, Mike, than the January.
It should be more realistic, in my opinion. I think consensus is calling for 60,000. We'll see if that comes in lower. Last month was a big upside surprise, came in 130. Like I said, I think that'll get revised lower, maybe closer to the 85,000 range. Still a good report, but yeah, I think. And we saw a downtick in the unemployment rate, but that's been contrary to the recent trend. So we'll see if that goes back up to the upside or not. We continue the Challenger job report, and we'll get an update on that next week. But it was very bad in the last reading. So that it signifies that it tracks what companies are announcing layoffs. So that number has substantially risen, and you've seen it from a broad range of companies, tech, other areas. So something to keep an eye on. It's not the consensus data, but the major non-farm payrolls, but it is something to pay attention to. So we will be talking about all that on Friday. Everybody have a good weekend. David, enjoy your trip. And before we go, I'm going to flip on the disclosures, and we will see you next Friday. Make sure you keep an eye out for our blog posts.
Super.
Securities offered through LPL Financial LLC, member FINRA and SIPC.org. Advisory services offered through LPL Financial LLC, a registered investment advisor. Brian Peluso, Michael Kutch, and David Harper are registered representatives of LPL Financial LLC. Content discussed is for informational purposes only and not intended as an offer or solicitation to buy or sell any security or investment strategy. Any opinions expressed are those of the authors and do not necessarily reflect the views of LPL Financial or its affiliates. All investments involve risk, including the possible loss of principal. This communication may include links or references to third-party websites. These links are provided as a convenience only. LPL Financial and its representatives are not responsible for the accuracy or content of such sites. Brian, Mike, and David and HBK Provident Advisors may only transact business in states where they are properly registered or exempt from registration. Please contact us directly for information regarding licensing and registration status. Past performance is not indicative of future results. You should consult with your financial advisor, tax professional, and/or attorney regarding your specific situation before making any investment decision.